Welcome to the deep dive. Today, we're digging into a stack of sources on Cipher Mining, ticker CIFR. This is a company that just pulled off one of the most, well, jarring strategic pivots we've seen lately. Yeah, for the past few years, Cipher's really been known mainly as an industrial scale Bitcoin miner. But wow, they just announced a massive move, really, into artificial intelligence hosting. We're talking a multi-billion-dollar shift, a 10-year, $3 billion AI hosting deal, and the really big headline, it's backstopped by Google.Alphabet. But here's the puzzle, the real mystery we need to unpack today. At the same time they announced this incredible news, they also announced an $800 million convertible notes offering to fund it all, presumably. And get this, despite the huge Google-backed deal, the stock dropped over 16% in one day. Why? That's what we need to figure out.
That's exactly the core mission for us today. We need to dissect this new dual identity they're creating, this AI crypto hybrid bet, as some are calling it. Cipher, only founded back in 2021, is changing its whole risk profile incredibly fast.
Yeah.
So we need to understand the strategy, the risks involved, the financing complexity, and why the market seems so confused. Is this great news or is the cost too high? What does it really mean when you land Google's backing but your stock tanks immediately?
We'll try to figure out what these pretty aggressive moves mean for you, the learner. Let's jump right in. Okay, first things first, let's unpack that landmark $3 billion agreement. It's huge. A 10-year hosting deal with a company called FluidStack. And it's for high-performance computing, HPC hosting. This isn't like a small test project. It looks like serious long-term contracted revenue. A big shift from pure crypto speculation.
Exactly. And what's fascinating here is both the sheer scale and the technology involved. Cipher's committing to deliver 168 megawatts of critical IT load. That's a lot of power, and it has to be ready by September 2026 at their Barber Lake site. And crucially, like you said, it's for HPC.
Right. Can you explain the difference for us? Why does HPC make their existing setup so valuable compared to, say, standard cloud stuff?
Well, HPC is really about that dedicated, super high-intensity processing power, the kind you absolutely need for training these massive AI models, deep learning, the really heavy lifting. It's stuff that runs flat out 2047. That's why their huge power capacity sources are putting it somewhere between 2.4, maybe 2.8 gigawatts total is suddenly gold dust. They basically built this massive energy infrastructure for Bitcoin mining, and now they're perfectly positioned to repurpose it for arguably the highest demand computing workload out there.
And here's the part that should have sent the stock soaring, you'd think. Google's involvement. Google actually took a 5.4% equity stake in Cipher. That's significant.
It is. It's a strategic investment.
But even more critical, maybe, is that Google is backstopping $1.4 billion of FluidStack's lease obligations with Cipher.
Yeah, that Google backstop really changes the whole risk calculation, doesn't it?
Yeah.
It's a massive vote of confidence from, well, a tech giant that desperately needs reliable AI infrastructure to effectively transform Cipher, makes them look much more like an AI infrastructure play that just, happens to also mine Bitcoin on the side.
So the immediate impact, as you said, is diversification. Moving away from that pure, often brutal Bitcoin price volatility, creating a stable, long-term contracted revenue stream. Okay, that stable revenue sounds great, but building 168 megawatts of HPC capacity, that doesn't come cheap. Which brings us neatly to the second big announcement, the one that probably spooked investors. That proposed private offering of $800 million in convertible senior notes.
Right, we really need to look closely at the structure of this financing because it sort of hides the true cost of this big expansion. These notes are senior, they're unsecured obligations, and the detail that catches everyone's eye is they bear zero interest, 0.00%. They mature way out in October 2031. So on the surface, it means Cipher gets $800 million cash right now without any immediate interest payments hitting their books. It sounds almost like free money. Gives them a really long runway.
Hold on a second, though. Money's never really free, is it? If there's no interest, what is the cost of taking on this huge $800 million debt, and how does that maybe connect to the stock dropping?
You've hit the nail on the head. That's the central trade-off. The real cost here is the potential for massive shareholder dilution down the line. Convertible notes, eventually they turn into company shares. And if $800 million was converts, that could dilute existing shareholders quite significantly. The market hates that kind of uncertainty.
So the debt raise itself, not the AI deal, is likely the trigger for the stock plunge.
That seems the most plausible explanation for the immediate negative reaction, yes. The AI deal is long-term positive, but the financing introduces immediate dilution risk. Now, the plan is to use the proceeds to fund the Barber Lake construction for the AI deal, speed up other HPC development across their pipeline. But they're also using a chunk of that cash to fund something called capped call transactions.
Okay, that sounds like financial jargon. Can we break down capped call transactions simply for, for our learners?
Sure. Think of like buying insurance against your own stock dilution. Cipher is spending some of the money they just raised to buy options. These options are designed to basically offset some of the dilution if, or when, the notes convert into a large number of new shares later on. It helps limit the potential damage to the share price from the conversion.
So they're hedging against the downside of the very financing structure they chose.
Essentially, yes. It shows they're aware of the dilution risk and trying to manage it somewhat.
And this isn't the first time they've used this kind of strategic financing, is it? Didn't they do a smaller convertible offering not long ago?
They did, yeah. Back in May 2025, they priced a $150 million convertible notes offering. And interestingly, that one had a pretty strong 30% conversion premium built in, which signaled even back then that management was confident the stock price would go up significantly. Now they've basically taken that same strategy and multiplied the debt by more than 5 times for this huge AI pivot.
So the confidence is clearly still there, maybe even higher, but the execution risk also just went up fivefold.
Precisely. Bigger bet, bigger potential reward, but also bigger risk if things don't go exactly to plan.
Okay, so let's recap. We have this massive $3 billion Google-backed AI deal, which should stabilize revenues. Then $800 million in zero-interest debt to fuel the expansion. And yet, the market reaction. The stock price tanks 16.12% in a single day, trading down near $11.86. We really need to dig into this paradox.
It's a perfect example of market dissonance, isn't it? On one side, you've got the fundamental analysts looking at the long-term business. The consensus among 10 analysts is actually strong buy. They seem to believe in the pivot, fundamentally.
Okay, but then you look at their price targets, and it tells a completely different story. Their average 12-month target is only $8.13. That's over 30% below where the stock was trading, even after the drop. How does that make sense? Strong buy, but target way lower.
Exactly. It's fascinating. It suggests the analysts are perhaps anchored to more traditional valuation metrics, maybe lower Bitcoin price forecasts, or concerns about the rising costs and difficulty of mining. The huge gap tells us the fundamental analysts aren't really buying the AI story at this current share price. They might still be valuing it primarily as a crypto miner, which justifies a lower target. Meanwhile, you have speculative money potentially chasing this Google-backed AI unicorn narrative, pushing the price far above what the analysts think it's worth based on current or near-term projected fundamentals.
It feels like investors, maybe despite the AI hype, are still looking nervously at the historical financials. The company is still operating with a trailing 12-month net loss of -$154 million. That's a pretty big number to see alongside $800 million in new debt.
That's definitely part of the picture. But we should also look at the metrics that support the bull case. Their current ratio is quite healthy, 4.18. That signals strong short-term financial stability, liquidity. They can cover their immediate bills.
Okay, that's good.
Plus, their debt-to-equity ratio, even considering the new debt conceptually, remains relatively moderate at 0.25 based on recent data. Suggests they aren't grossly over-leveraged just yet. And let's not forget they also secured that $50 million investment from SoftBank earlier in 2025. Another big name showing confidence.
And operationally, they're not abandoning crypto either, right? They're still planning to scale their Bitcoin mining hash rate quite significantly, from around 13.5 exahashes per second up to maybe 23 EHs by late 2025, thanks to new sites like Black Pearl.
That's right. It really is becoming a genuine hybrid company, trying to balance both worlds.
Okay, so we have this company with huge contracted AI revenue potential, solid-looking financing, decent liquidity, but a market that just dumped the stock right after the big news. So let's bring it back to the investment question. What does this all mean? Let's weigh the key strengths, the bull case, against the critical threats, the bear case, based on our sources.
All right, focusing on the bull case first. Their biggest competitive edge, arguably, comes down to operational efficiency, specifically power costs. Cipher consistently boasts some of the lowest power costs in the whole Bitcoin mining industry. And since energy is the single biggest operational expense for miners, that low-cost structure is a huge advantage. It provides a vital buffer against Bitcoin price swings.
That makes sense. Lower costs mean higher margins, more resilience.
Exactly. And furthermore, analysts are forecasting the company could actually achieve profitability this year, driven largely by that high-margin, contracted revenue expected from the AI expansion kicking in.
Okay, but let me push back a bit. They have low power costs, good liquidity. but they just took on $800 million in debt, carrying significant potential dilution risk. And it's for an AI build-out that won't even be fully delivered for another 2 years, right? September 2026. Isn't it possible the market's reacting less to Bitcoin volatility and more to the massive execution risk? The risk that comes with trying to manage a five-fold capital expansion like this.
That's absolutely a key part of the challenge and central to the bear case. The argument is that while low power costs are great, they don't completely shield Cypher from other industry headwinds. Things like increasing network difficulty in Bitcoin mining, fierce competition, the global hash rate is always climbing. That makes it harder and more expensive for all miners to maintain their market share without constantly investing huge amounts of capital.
So the $800 million isn't just for the AI pivot, it's also potentially just to stay competitive in mining too.
It likely serves both purposes, yes. You need capital just to keep pace, let alone execute a major strategic shift. And we did see perhaps a small red flag earlier in the year regarding their cash management. Remember back in February 2025, Cypher actually sold more Bitcoin than it mined in that month. Now, that could be for very strategic reasons, but it does highlight that their core legacy business is still intensely vulnerable to sharp downturns in the Bitcoin price. That remains the fundamental risk for pretty much all crypto mining stocks.
So it really boils down to this tension, doesn't it? You've got the promise of a reliable, long-term, contracted revenue stream from the new AI business, set against the highly leveraged, intensely volatile, legacy Bitcoin mining operation. When you invest now, you're essentially betting on whether that steady AI infrastructure revenue will eventually win out and dominate the company's valuation, finally overshadowing the crypto swings.
That's the core bet, precisely. Will the AI pivot successfully de-risk the company profile in the eyes of the market over time?
Okay, let's try to summarize this deep dive then. We've seen Cypher mining undergo this incredibly rapid transformation, from a pure play Bitcoin miner to potentially a major AI infrastructure player, all fueled by a huge Google partnership and significant new funding. And yet the stock market's immediate reaction was, well, extreme caution, dropping 16% right after the news broke.
Yeah, and if we connect this to the bigger picture, Cypher is really a perfect, very high-profile example of a broader trend. We're seeing these digital asset infrastructure companies almost being forced to adopt hybrid business models. They're actively seeking stability, trying to mitigate those inherent systemic risks tied to cryptocurrency price volatility and mining difficulty changes. This kind of strategic diversification is fundamentally reshaping the whole mining sector. It feels necessary for long-term survival, frankly.
So your key takeaway here should probably be that Cypher looks incredibly strong on paper in many ways. You've got the low power costs, ambitious expansion plans, major backing from Google, but the market's immediate reaction, the valuation gap, it suggests investors aren't quite ready yet to price this as a steady, predictable, long-term AI tech play. They still seem to be treating it primarily like a volatile crypto stock, perhaps fearful of the massive debt load required to actually make this pivot happen successfully.
Which leaves us with a final provocative thought for you to mull over. Given that the stock price actually fell after this huge, seemingly fantastic Google-backed AI deal was announced, are investors signaling that the execution risk and the potential dilution from that $800 million zero-interest debt just outweigh the guaranteed revenue? Or are they truly just fundamentally fearful that the company's core Bitcoin mining identity is simply too volatile to overcome, even with the tech giant like Google giving its stamp of approval? Something to think about.